Happy Friday, traders. This is Fawad Razak, other market analyst for City Index. Today is the 3rd of November 2023. So the markets have reacted the way you would expect, really, after the jobs report from the US, disappointed expectations. And we also saw the ISM manufacturing PMI come in weaker than expected as well. So the headline jobs growth was 150,000, which was below expectations. And on top of this, we had a sharp revision in the prior 2 months numbers as well, to the tune of over 100K. So that was significant. And also the unemployment rate ticked up. So all of it continues to show that the jobs market is slowing, which is what the Fed wants, meaning therefore that the probability of another rate hike has basically fallen to zero. At least that's what we think. And if the trend of data continues in the way they are, then we could see the dollar weaken further. The only issue is that data globally is weak as well, especially in the Eurozone, which has prevented the euro dollar from staging a more meaningful recovery, although it's up today. By the way the uh, yields have fallen, it should be a lot higher, one would think, compared to where they are, breaking its October 12th low at 453. That level is very important to watch now. If we can close below this level either today or in one of the upcoming sessions next week, then that would confirm a bearish reversal for yields, which should weigh further on the dollar, you would imagine. But interest rates are going to remain high for a long period of time still. So it's possible that yields may consolidate their recent gains around current areas. And if that's the case, then that could put some downward pressure on precious metals and keep the downside limited for the dollar. The euro dollar has broken a key level of resistance today, breaking above last week's high of 106.95. So it has created a higher high here. And it looks like a run towards 108 is now on the cards. 108 comes in just ahead of the 200-day moving average, which is still pointing lower, suggesting that the longer term trend is still bearish. But the recent price action has clearly been bullish on the euro dollar, so we could well see some further upside continuation. The Nasdaq is also looking quite positive after rising for several consecutive days. It is, however, reaching the bearish trend line that has been in place since when the markets topped out in July. So that would be the next big level to watch at around 15,150 or so, where we may see some weakness creep back into the market. However, the pace of the recovery is quite impressive ever since it reclaimed that broken level at around 14,430. It has not looked back. Following the release of weaker data today, the price of gold climbed above 2,000 once again, but it is coming off its earlier highs. So let's see whether it can kick on from here and move north of that key resistance level, or we'll see another bearish reversal there. So far, it's not looking very convincing, but it is quite late in the session here in Europe. So the breakout, if it happens, could be on the cards in early next week. On the downside, the key level to watch is, well, there are a few levels. This level is important, 1969, this week's low. Below that, we have 1953, the most recent low prior to the rally that reached a high just over 2000. So if that level breaks, we will have created a short-term lower low in place, and that would be a bearish signal. So that level is now the line in the sand for me. For more analysis, make sure to check out the news and analysis section at cityindex.com. I'll see you next week.